Our Frank Holland is here on set with us with all the details. Frank.
Yeah, Melissa, early warning here on the earnings, and it really hit the stock. The company issuing that warning saying it's facing a soft macro environment when it comes to all of its businesses, including its signature air delivery business. Had a miss on revenue, an even bigger miss in EPS. Obviously, that pressured the stock. But it's really the forward guidance, that EPS guidance that's hit in this stock. Take a look at the numbers. You can see here, you don't need to be a mathematician to figure this out. FedEx guiding about half of what the street's looking for. It's also withdrawing its fiscal 2023 guidance and revising its CapEx lower, saying it expects business conditions to weaken into Q2. In the report, CEO Raj Subramaniam spelling out the issue, saying in part, global volumes decline as macroeconomic trends significantly worsen later in the quarter. Also adding in the report, the impact of cost actions lag those volume declines, and operating expenses, they remain high relative to demand. Spoke with a few company executives. They say the U.S. volumes, they're certainly softer, but the big issues, they're overseas. The integration of that TNT delivery network in Europe, bringing systems online, et cetera, something that has been a continuing drag on results. Also, COVID lockdowns in China lasting longer than expected, and volume returning happening much slower than expected. So kind of getting hit on both sides. To cut costs, FedEx plans to reduce flights for that signature air delivery, cut hours for workers, and close about 90 FedEx office stores, again, to cut costs as it faces weakening demand.
The context, though, to this, Frank, is that they gave guidance, or they talked about their guidance and their forward-looking, forecasts June 23rd.
Right.
So this is really falling off a cliff, literally, because for them to cut in half what their guidance is for the quarter since June 23rd, I mean, it's amazing what has changed.
Well, in all fairness, FedEx obviously seeing a much different picture, but even analysts, I was there at their investor day in June. Everybody was feeling very optimistic about FedEx.
Yeah.
They put out some very optimistic targets for future fiscal years, also raised the dividend. So obviously a lot of optimism. Generally, companies don't raise their dividend unless they're feeling pretty good about what's coming up. So just a big change. One thing that I don't think anybody could have forecasted is that volumes in Asia being much slower to resume than people expected. Those COVID lockdowns lasted longer. And here in the U.S., spending slowed down a lot faster than people thought.
Frank, thanks so much. Frank
Thank
Holland
you.
with all the latest. We've done this a few different times where we've talked about FedEx warning. So how much of this is FedEx and how much of this is the environment, Karen?
Well, I don't know for sure, but always some of it is FedEx. The irony that the one thing they delivered earlier on time was a pre-announcement. So we were supposed to hear next week.
I get that.
It's not funny, though. I'm long.
Oh,
so
okay,
I'm
fun.
long a little less now than I was an hour ago for a few reasons. One is this is disappointing. I think this cutting in half is actually making it a little worse than it seems. They probably had some charges for doing some of their cost reduction initiatives. One thing I find a little hard to believe, they feel very confident in the cost reduction initiatives as it relates to 2025. I find that a little hard to believe, given that June 23rd, they felt really good about
this
August, September of this year. So it is a very difficult environment. I'll give them that. But it's very, very frustrating. It's difficult. We have a new-ish CEO. He was sort of, he's been there a long time, but in that role for not that long. And I think what's going to happen is, even though it's cheap, I think what's going to happen is we are going to see a number of companies now start to say something similar. And FedEx, with its reputation for missing, will trade down each time.
Right.
Even though they've already said theirs.
Right.
I just feel like it will get pounded again and again. So now I just think, all right, you know what? I'm going to lighten up. I'm going to do, some tax efficient trading, sell high cost. If I want to revisit, I can either buy UPS or I could wait 31 days and buy FedEx. But very, very disappointing, both for FedEx specifically and then questionable more broadly. What does that mean?
Speaking of other companies talking about the difficult environment, GE warning just moments ago on the supply chain. The CFO actually saying the supply chain continues to be tough, continues to impair its ability to deliver to customers. So that stock is down 5%, just adding to this sort of corporate bad news wave here, Tim.
Well, I worry less about GE only because this is a dynamic on supply chain and things. First of all, we've seen this before, and FedEx is so much more cyclically important to the economy. And what I think I heard Karen saying, though, she might as well have said UPS is running their business so much better than FedEx. Yeah. I mean, that's really the story. And when you think about UPS, their ability to handle short-term cost pressures, their ability to actually balance their margin, their gross margin is probably 3 or 4 turns better than FedEx's. But ultimately, and Frank mentioned the analyst community and really where they are on this. Citibank's Chris Weatherby actually downgraded FedEx. I think it was a week ago today, or maybe early last week. And great foresight. But again, the same point was what's the issue that is different about GE to FedEx is, look, this is a warning on demand. This is a warning on freight volume. This is a warning on TL volume. This is a story where we're all looking to see where in cyclicality and in FedEx, this is where you get that visibility.
Yeah, Courtney.
Yeah, I think that's the big thing here, right? Is if demand is going down, I think what does that mean for the bigger picture? Because we have to see a slowing economy and we have to see that deterioration in consumer demand in order for eventually the Fed to start lowering interest rates, which, as we saw with that CPI report, people don't think it's coming anytime soon. But if we do start to get more data like this coming out, that does start to really have an argument against if they need to continue being so aggressive with their rate hikes.
Right. I mean, there's also the question of the corporate side of the business in terms of businesses sending packages, et cetera. And so we have not, as you've made the point repeatedly, we have not heard any sort of
demand is
from
not,
on enterprise spend.
Yeah.
And so you got to wonder if that's coming down the pike.
So let's kind of take it back a few months. OK, we had a couple of these double downgrades of guidance going back into the spring. Right. We saw Snap do it. We saw Target do it. We saw Microsoft do it. And Microsoft was really interesting. They guided on currency, but they didn't, again, on two occasions over the last 4 months, they said they're not seeing a weakening in enterprise demand. And I think if you're starting to connect some of the dots here, I mean, it's pretty simple to start thinking about when you see other companies at different parts of, how they touch consumers or how they touch businesses. It's not until we start seeing these layoffs and we start seeing basically, weak demand in other pockets, we're going to see enterprise companies start pulling back a little bit. I think it's interesting that we've seen companies push through as much of these input costs that they could, right, to defend their margins. We just saw S&P margins at like an all-time high or something like that. And I think what these warnings tell us is that that's not going to continue for the balance of the year. And we were talking about this last night. If you are a CEO and you used to be in a situation in the last couple weeks of a quarter or maybe the last month of a quarter and say, all right, let's make this quarter and let's just kind of figure out the next quarter as we can. I don't think that's happening. I think that's what's going on tonight with GE and with FedEx. I think we're going to see that accelerate into quarter end. So I think that, again, pulling the full year of this guidance just tells you how weak the visibility is right now.
They're not on a
fiscal year.
This current fiscal year starting right now.
Yeah.
Full year.
No, there's nothing good. There's no way to spin it good. There's no good.
I'm curious because Frank seemed to focus on Asia and the fact that lockdowns affected them much more than had been anticipated. But in terms of Europe, you got to wonder about fuel costs there and just sort of demand just completely drying up given what is going on with inflation and energy costs there.
Yes, for sure. And that was some good margin business, right? So that's probably us. Just to the CapEx. I imagine they're cutting their own CapEx, FedEx, right? I don't know if GE will announce something similar. Maybe they're not quite as enterprise spendy as some of the. Maybe it's a little more industrial spend, but I guess we're going to see more broadly.
And FedEx has made it clear that they've been a little bit longer term thinking than UPS. And that's part of where I think on the here and the now, on some level, we should be thinking out really into their fiscal 24, except for the fact that this is a company that has, as Karen pointed out, a lot to fix in terms of how they are addressing. And as Dan pointed out, the pricing power that these shippers have had, they've raised prices through. They got the higher end of a price range about 4 or 5 months ago. Let's see what they can do going forward.
Just taking a look at how the stocks are reacting in the after-hour session, that tells me at least that this is much more of a FedEx issue than anybody else's issue, given UPS is down 5% and FedEx is down 15% at this point, Court.
Yeah, that's exactly right. And I think that's what you want to look at here is FedEx. Clearly, this is going to be a problem for them. And when you look at them, they're down, 14% right now. And they have done this before where they're going to really take down their guidance and try to beat that. And I think moving forward, it's not something I'm worried about from the overall market.
Yeah. Dan?
Well, I mean, listen, when you think about a UPS, I mean, these were cheap stocks relative to the markets. I know you guys have preferred FedEx on valuation, high single digits PE multiple versus the expected growth this year. It looked like on a PEG basis looked pretty attractive. And I think that's one of the things. I think some of these stocks that look like really good values as the economy might start to. I think that what a lot of investors were starting to think in June is like we're pricing the worst case scenarios in, right? And so you have a 2-month rally and all of a sudden, a lot of us are like, no, the economy is weakening. We had the deceleration in the first half of this year versus the pandemic comps, and now we actually have a weakening global economy. And I think put the situation in Europe and China into it, it's really hard to just kind of conceive a scenario where we are not going to be in a recession. I know the recession word doesn't matter, but take these companies for what they're telling you. When you have companies pulling full year guidance, it tells you they have no visibility.